Hello everyone, thanks for watching this video on how to measure the performance of a company. In this section, we will learn the basics and the tools that will enable us measure the performance of a company. We will do this through what is popularly known as financial accounting, which I believe many of you have some foundation in. As usual, a few things before we get started. One, if you're watching this video because you are struggling in the class right now, I want you to stay positive and keep your head up. If you're watching this video, it means you have accomplished quite a bit already, and you are very smart and talented, but you may have hit a temporary rough patch. Well, I know that with the right amount of hard work, practice, and patience, you can work through it. I have faith in you. Many other people have faith in you, so should you. 2, feel free to follow us here by subscribing to the channel or on Facebook or LinkedIn at Prop Intel Limited. That way, when we upload new videos, you'll know about it. And it's always nice to connect to our viewers online. 3, if you like the video, please give it a thumbs up, share it with your classmates, and put it on a playlist. That does encourage us to continue making them for you. On the flip side, if you think there is something we can do better, don't hesitate to leave a constructive comment in the comment box, and we will take into account those ideas when we develop new ones. Finally, just remember that the videos are meant for individuals who are relatively new to finance. And so if maybe a student in an introductory finance or investment appraisal class, or someone who just needs to brush up on basic finance theory and concepts. And so the presentation will be slow in a deliberate manner to enable you follow all the processes. Having said all of these, let's get started. In today's presentation, we will focus on two main things. Now, we will build the concepts and the tools that will enable us measure the performance of a company. And so in the first section, we'll focus on the theoretical aspect and the concepts that would enable us to do this. And we'll do this by analyzing financial statements. And then in the second section, after we have built the knowledge, the concept, and the tools, we will then apply these tools to the measurement of the performance of a company. So let's look at something here. Almost every company, or every company, has what we refer to as company accounts. Okay, and these accounts usually come in 3 main forms, which we will refer to as financial statements. Okay, so basically the financial statements of a company enable us or give us an idea of the performance of that company. So there are 3 main components of a financial statement. The first one is what we refer to as a balance sheet. The second form of financial statement is what we would refer to as the income statement or the profit and loss account. The third type of financial statement would be the cash flow statement. So let's delve into the details of these financial statements. The balance sheet. The balance sheet is a financial statement that shows a firm's accounting value on a particular date. In other words, it gives a snapshot of the company's assets and liabilities on a given date. Okay. However, unlike the balance sheet, the income statement summarizes the performance of a company over time. And thus, it represents a period of performance of that company. Usually, it will be measured over the accounting year. For many companies, this will vary according to company and company. And in the income statement, you would come across many items, such as the revenues and the costs associated with operating that company. Now, the cash flow statement refers to that financial statement that enables you to see how money is exchanged in the company. And by the exchange of money, I'm looking at how revenue comes into the company and how revenue is expended in the form of cost. So let's look at each one of them in detail. So the balance sheet. There are items to be found on the balance sheet. And in fact, in any balance sheet, you'll find three main items. One is the assets of the company. And these assets of the company represents the items the company has or will receive. The second item you find on the balance sheet is the liabilities of the company. They represent the items the company owes or will pay. And then the third item on the balance sheet is shareholders' equity, which represents how much money shareholders of a company has invested in that company. Now, the balance sheet of a company can be summed up in a mathematical equation. And here, we have indicated that the balance sheet of a company shows the assets, liabilities, and the shareholders' equity in that business. And so we can show this by looking at this mathematical formula shown here. So you can see that the total assets of a company is equal to the sum of the company's liabilities and its shareholders' equity. Now, when we rearrange this equation, we can also compute shareholders' equity and liabilities. And in this case, when we move the liabilities, or basically when we subtract the liabilities from the assets of a company, what is left is the shareholders' equity. Now, all balance sheets have two main forms of assets. One is what we refer to as the current assets of the company. And the second asset is what we refer to as the fixed assets of the company. The fixed assets may also be referred to as capital assets of the company. Now, what are current assets? Current assets of a company are short-term investments, or they are short-term assets of a company. It may be in terms of a financial asset in the form of monies owed to the company by debtors, or it may be a physical asset in the form of inventory. And so if you pick a real estate development company, for example, that builds houses for sale, its inventory would be the houses it builds. And three, a very important characteristic of current assets is that these assets are expected to be transformed into money within 1 year. Okay, so basically, current assets are those assets that are used in the production of goods and services by a company within 1 year. Now let's look at fixed assets. So unlike current assets, fixed assets are very capital intensive items that a company buys or procures. They are not short-term, but rather long-term in terms of their usage in the production of goods and services in the company. And they may be tangible, as in you will be able to touch them and feel them. And usually these tangible assets are referred to as the PPE of a company. So PPE stands for the plant, property, and equipment of a company. So, and basically this makes sense because almost every business uses some form of real estate. So the offices from which these businesses operate from will form part of its property. If it's a retail shop, then the shop from which it is working from or selling its goods and services would also be part of its PPE. It may be intangible as well. And intangible means that you cannot touch it physically. And an example of an intangible fixed asset is goodwill. So when a company builds its goodwill over time, it forms part of its fixed assets. And usually fixed assets depreciate over time. An example is a building. A building over time loses its value if over time. So a computer, for example, would also lose some form of value over time as it is used over and over and over again. So when you pick a real estate development company, for example, a company that builds houses, for example, you would often put that company, the houses it builds for sale, which in other words constitutes its inventory, under its current assets. Now, when that company converts these development properties, which are up for sale, into investment property, that is, it rents them out for rent instead of profit upon sale, then this investment property will fall under its fixed assets. In this chart, we basically show that the total assets of a company is made up of its current assets and fixed assets. And these total assets of this company is a sum of its liabilities and its equities. Now let's consider the liabilities and equity of a company. Now, the liabilities of a company will usually come in two main forms. You have what you refer to as the current liabilities of a company and the long-term liabilities of a company, or the non-current liabilities of a company. Now, what are current liabilities? So these liabilities are monies owed to other companies that are due in 1 year. And examples of current liabilities are accounts payable to suppliers and short-term debts. So for example, if a company borrows maybe a 3 months, a loan of 3 months, or a loan for 3 months from a financier to build houses, because it is less than 1 year, we'll classify it under its current liabilities. Now, when a real estate development company, which builds houses, decides to procure materials on credit from suppliers, those materials will be treated as what we refer to as accounts payable. Now, the non-current liabilities of a company are usually those liabilities that are due after 1 year, okay? And they are normally long-term investments, or they are normally used to finance long-term investments. And examples of this would be a bank loan to build an office, for example. It may also be a corporate bond that the company has issued to raise money for its long-term activities. Now, when we subtract the liabilities of a company from its assets, what is left, okay, the residual value of that company is what we refer to as the shareholders' equity. So shareholders' equity represents the amount of money that is attributable to the owners of the company. So basically, how much money have they invested in there, or what is the worth of the money they have invested in that company? Okay, and usually we would look at that in terms of the residual value of the company. Now, shareholders' worth would often be used to finance long-term investments, and it may be categorized into some forms, or they may come in some forms. For example, shareholders' equity may be in terms of ordinary shares. It may also be in terms of preference shares. It may be in terms of retained earnings and the revaluation of the reserves of the company. So once again, this diagram here shows the relationship between the total assets of a company, which is the sum of its current assets and fixed assets. And here, we see that the total assets of the company is the sum of its current liabilities, its long-term liabilities, and shareholders' equity. Now let's look at another dimension of the balance sheet. And here I want to talk about the net working capital of any company. Now, every company needs capital for its day-to-day activities. So for example, the company needs to get supplies, it needs to meet its transportation needs for its staff when they run errands for the company. They need to pay some short-term loans, debtors here and there, and basically money needed for day-to-day activities will be classified as working capital of that business. And working capital of that business is effectively the difference between the current assets of a company and its current liabilities. So basically, when we subtract current liabilities from the current assets of a company, we arrive at this net working capital. It is that amount of money that is left for the running of the company. And as you can see here, this diagram shows how the net working capital of the company can be computed. Now, let's move away from the balance sheet and look at another form of financial statement. And here, I want to introduce the income statement or the profit and loss account of a company. Now, the profit and loss account of a company basically shows you the revenues, the costs, and the profits of that company. And these are the three main items you would see in any financial income statement. Now, the goal of a financial statement is to demonstrate the profitability of that business. And so the income statement will show the profits or the losses the company have made over a period of time. And we can compute the profit or the losses the company has made over time by deducting the revenue, the costs incurred in the production of goods and services from the revenues received from the sale of those goods and services when they have been produced, as you can see here. So these diagrams once again show these relationships. So when we add costs and profits together, that gives us revenue. And then when we add revenues and losses together, that gives us the cost of a business. Now, it is also important to understand some of the components of the income statement. We have said that the income statement reflects the revenues, the cost, and the profit or loss of the company. Now, let's treat revenues. The revenues of a company are usually what we refer to as positive cash flows of the company, or they are the cash inflows of the company. So basically, it is money that comes into the company. Okay, and there are three main sources of revenues to any business. One is revenue generated from the core business of the company. So, and usually it will be from the sale of goods and services. So for example, let's go back to our real estate development company once again. The inventory of a real estate development company is a real estate it develops. So for example, if you have a real estate company that builds houses, then the houses constitute the inventory of the company. When that company sells these houses, it brings in revenue, and that revenue will be attributed to its core business. Now, there are other linked activities. So when you have a dedicated real estate developer who also provides other ancillary services, like for example, valuation services, the fees it earns from those accessory services or ancillary services will be classified as other linked revenues from other linked activities. And then a company can also make or generate revenue from its financial activity. By financial activity, I mean if a company decides to create an account for that company and therefore make some deposits into that account, the interest the company earns will be classified as revenue from its financial activity. It could also be returns on its investments. So if a company decides to lend some money to another company in the form of, say, a corporate bond, the returns from that investment may be classified or will be classified as a return or revenue from its financial activity. Now let's look at the cost component of income statements. So the cost component of income statements are also classified or described as the negative cash flows of the company. In other words, these are the cash outflows of the company. These are monies that leave the company, okay, that are paid to service the liabilities of the company. And there are also three main sources of cost to most businesses. One is the cost the company incurs as a result of its core business. And it may incur these costs in terms of the purchase of materials, the payment for utilities such as electricity, and the wages and salaries it pays its labor or personnel. Okay, so for example, when we go back to our real estate development company, which builds houses, it needs sand, cement, and other aggregates to be able to build these houses. It also needs land, it needs electricity, and it needs labor to be able to put up these buildings. The cost associated with these items will be attributed to its core business. Now, then again, the company may also incur costs as a result of its financial activity. So for example, because real estate development is a capital-intensive venture, many developers will borrow money from banks or financial institutions to be able to undertake this activity. Now, when they borrow money, they are required to pay interest on this money or this debt. That interest payment or that interest expense will be classified as a cost resulting from the financial activity of the company. There's also what we refer to as costs associated with physical activity. Now, almost every business is required to pay taxes from the revenues it has generated to the state. And so all forms of taxes will fall under the costs attributable to the fiscal activities of a company. And these three main sources of cost of any company would usually be classified as cash items. They are cash items. Okay. Then what this brings to mind is that there are also another category of costs that are not cash-based, and these will be classified as non-cash items. Now, these non-cash items, unlike the cash items, do not generate a cash flow. An example of this is the non-cash item called depreciation. So depreciation would often result from accounting rules. The accounting rule will determine how fixed asset is depreciated over time. So take note of this because it becomes an important component of our analysis going forward. Now, when we pick the income statement of any company, it is important to know how we can arrive at the profit or the loss that a company has made. And so the first thing to look out for is the revenues from the company. And the revenues would usually come from the sales of the goods and services of that company. So the total revenues minus the core business cost will leave us with what we refer to as the earnings of the company before interest, tax, depreciation, and amortization, which is shortened as EBITDA. Now, when we subtract depreciation from EBITDA, we are left with the earnings of the company before interest and taxes are paid. And when we subtract this, the interest the company has to pay on its loans, which have been procured or acquired for its business operations, then we'll be left with what we refer to as the earnings of the company before tax, or EBT. Now, when we subtract tax, or when the company pays its taxes to the state, now its revenue, or the remaining revenue, is what we refer to as the earnings of the company after tax, or EAT, as you can see on this slide. And EAT, or the earnings of the company after tax, represents the profit or the loss of the company. Another important financial statement we looked at was the cash flow statement. Now, the cash flow statement, as we showed, or as we indicated earlier on, is that financial statement that shows the flow or the exchange of money in the company. So how does money move in the company? So usually the cash flow statement will take this form. It will usually start with cash at the beginning of the year. And then this cash at the beginning of the year is adjusted for net cash from its operating activity, the net cash from its investment activity, and then the net cash from its financial activity. This together will show us the net change in the cash of the company. Now, when we add this net change in the cash and the cash at the beginning of the year, it will bring us to cash at the end of the year. So this cash flow statement will become another important statement, or another important item when we begin to think about investment appraisals. For many projects, there will be a need to develop cash flow statements for them. So at this point, I would like to end this presentation, and then we'll look at how to apply these concepts as we have seen them in another video, which will come to you soon. Thank you very much.